Hi, friends. The past 2 weeks has reminded me again that markets are rarely as predictable as they seem. Even when the smart move is lined up with solid reasoning, sentiment and timing can throw a wrench into our best laid plans. Over the past few weeks, I found myself face to face with that reality, especially as I navigated a gold short that went the wrong way, at least at first. But here's the thing, every move, every misstep is part of the learning curve. And this month's newsletter is all about that, how we refine our skills in real time, respond to changing conditions, and develop strategies we can trust. I'll walk you through what happened, what I've learned, and why simple tools like a trade journal are turning into some of my most valuable allies. Let's dig in. Investor journey, when patience isn't a strategy. Last Thursday, I entered a short position on gold via IAU at around $60.55. At the time, technical signals and sentiment suggested that gold had topped out temporarily. And with the FOMC meeting ahead, I anticipated a pullback. But by Tuesday, gold was climbing fast, and my position was firmly in the red. I watched the trade move against me, not because the fundamentals had changed, but because I didn't follow my own advice. Invest with the trend. Instead of closing the trade quickly and reassessing, I held it, hoping the reversal would come soon. So what happened? In the days leading up to the FOMC announcement, both gold and stocks reflected the market's unease. Gold climbed steadily while equities pulled back. Even though most expected the Fed to hold interest rates steady, there was growing anxiety about inflation and uncertainty about how the Fed might respond in the face of political rhetoric. That uncertainty alone was enough to push investors toward defensive assets like gold. When the Fed confirmed it would leave rates unchanged, and Powell offered no surprise shifts in tone, gold began to retrace downward, while equities bounced, recovering most of the losses from the early April tariff shock. It wasn't the Fed's action, but the lack of unexpected action and good news on the tariff front that helped ease volatility. For short sellers like me, that spike in gold ahead of the announcement was painful. But the retracement after gave us a chance to reassess and realign with the trend. Now, the trade is slowly drifting back toward my original entry point. But here's the lesson. Trades based on hope are expensive, not just in money, but in opportunity. Had I exited quickly and reversed with the trend, I could have participated in the upside. Instead, I've spent the week waiting to recover instead of reallocating that capital to stronger positions. Patience is an investing virtue, but only when it's backed by strategy, not regret. Going forward, I'll be sharpening my discipline by cutting losers early and riding with the market, not against it. At least that's the plan. Investor journey, tracking trades, finding truth. For a long time, I've tracked my trades in a notebook-style journal where I write out the details, my rationale for entering the position, and what I learned after the fact. It helped me process each trade as a learning experience, and I assumed that depth would lead to better performance. But recently, I started using a much simpler tool provided by a coach. It's a trade journal formatted more like a spreadsheet. Instead of paragraphs, it asked for numbers, entry and exit points, size, gain or loss, and a line or two about the why. What I didn't expect was how much clarity this simpler format would bring. Transferring my old trades into the new structure made the patterns impossible to ignore. My win rate was awful. And if it weren't for one long-dated SPY put hedge, which I've written about before, the overall results would have been disappointing. That single position had done all the heavy lifting, quietly offsetting the small experimental losses and keeping the portfolio balanced through volatility. It was a powerful realization that strategy, not experimentation, is what sustains results. From that exercise, I came away with two very clear goals. First, improve my win rate to 50% by only entering trades that move with the trend. No more maybe it'll turn trades. Second, only take positions that offer a minimum of 3-to-1 reward to risk. If I'm going to risk $100, the upside must be at least $300. That math is what makes a 50% win rate work. It's also what separates random bets from strategic setups. The more I review my trades, the more I realize that building a repeatable system where entries are intentional and exits are decisive is the difference between dabbling and developing true investor skill. That's where my focus is now, identifying my edge and sharpening it with every trade. I'll let you know how it unfolds as I go. Investor Skills Corner. This issue's glossary highlights some of the foundational skills behind trade decisions and performance. FOMC, Federal Open Market Committee, the policy-setting arm of the Federal Reserve. The FOMC meets regularly to assess the state of the economy and decide whether to change interest rates. Their decisions and even the anticipation of them can cause significant moves in the markets, especially in interest-sensitive assets like gold and bonds. Support level, a price point where an asset historically finds buying interest and tends to stop falling. Traders often use support levels to set entry points or manage risk. A new support can emerge when a market reevaluates what it believes an asset is worth, as we're watching with gold around $3,000 to $3,200. Short selling or shorting, a strategy used to profit when an asset's price goes down. Instead of buying low and selling high, a short sale begins by selling something you don't yet own, expecting to buy it back later at a lower price. Inverse ETFs, like those for gold or the S&P 500, offer a way to short without borrowing shares or using leverage. Trend, market trend, the general direction in which a market or asset is moving. Recognizing whether the trend is up, down, or sideways helps traders align their entries with momentum rather than hope. One of the most important skills for improving your win rate is learning to only trade with the trend, not against it. Reward to risk ratio, a way of evaluating whether a trade is worth taking by comparing how much you stand to gain versus how much you're risking. For example, risking $100 to potentially make $300 creates a 3-to-1 ratio. Maintaining a strong reward to risk ratio is how traders stay profitable, even if they only win 50% of their trades. Win rate, the percentage of your trades that end in profit. A high win rate might sound ideal, but it's not everything. When paired with solid risk management and reward to risk ratios, even a 50% win rate can be highly profitable. Without that balance, even frequent winners can lose overall. Trade journal, a record of your trades, including entry, exit, size, outcome, and notes on strategy or psychology. Keeping a journal helps you track patterns, refine your strategy, and hold yourself accountable. Whether you prefer written reflections or spreadsheet-style summaries, consistent journaling is one of the best tools for growth. What's happening now in the Women's Wealthy Ways tribe? Our community has always been about more than just investing. It's about learning together, supporting each other, and building something meaningful through conversation and workshops. Whether we're connecting during our Friday macro calls or diving into deeper discussions, these moments create a strong foundation of shared knowledge and support. If you haven't joined a Friday call yet, now's the perfect time. Follow the link in the newsletter to register. As some of you know, I've started a Substack blog. It's different from this newsletter in that I talk about anything that I find interesting, from technology to economics, psychology to geopolitics. Everything that humans do is reflected in the systems we have created. Understanding the many systems humans have created and that we all participate in is key to successful investing and makes it much more interesting than just watching numbers go up and down. I publish every week on Wednesday and would love you to check it out and let me know what you think. The Substack is called Financial Education Reimagined. Upcoming events. Bitcoin is on the rise again, and that means more people will be interested in learning how to catch the gains. Our Wise Crypto Investor Workshop has been a game changer for past participants, igniting both their enthusiasm and their portfolios. We're taking reservations for the next Wise Crypto Investor Workshop. If you're ready to dive in, click here to join the wait list. Don't miss out on this chance to take your investing journey to the next level. There is a maximum of 8 participants per class to ensure a personalized experience. Final thoughts. Each trade teaches us something new about the markets and about ourselves. This month reminded me how easy it is to slip into hope mode when a trade turns against us, and how much clarity we can gain from simply tracking what we do. Mastery doesn't come from avoiding mistakes. It comes from learning to see them clearly, without judgment, and adjusting our strategies with intention. So here's my question for you. What has your most recent investing decision taught you about the markets or about yourself? Hit reply. I'd love to hear. Until next time, keep practicing and learning. P.S. If you'd like to learn more or get involved in our Monday hands-on workshops or Friday discussions, send me an email. I'd love to have you join us.